Welcome back to Bull Mindset. Have you ever taken a trading loss that felt far more painful than it should have? Maybe it was a small loss, but it stayed in your mind for hours. Maybe it affected your confidence. Maybe it made you question your strategy. In today's video, you will learn why your brain often treats trading losses like physical pain, why losses trigger such powerful emotional reactions, and how understanding this process can completely change the way you approach trading psychology. Stay until the end, because the techniques we discuss could help you become calmer, more disciplined, and more consistent. And if you enjoy trading psychology content, consider subscribing to Bull Mindset. Now, let us begin. Most traders think losses are purely financial events. Money goes down, the trade closes, the loss is recorded, end of story. But the brain does not experience losses that way. The brain experiences losses emotionally, psychologically, sometimes even physically. This is one reason why trading can feel so difficult. The charts may be simple, the strategy may be simple, the risk management plan may be simple, yet emotions become overwhelming. The reason is that your brain is responding to something much deeper than numbers on a screen. Let us start with a simple reality. Human beings are naturally wired to avoid loss. This tendency developed long before financial markets existed. For most of human history, losing resources could threaten survival. Losing food, losing shelter, losing security. The brain evolved to take losses seriously. As a result, losses often create stronger emotional reactions than equivalent gains. This is why losing $100 often feels more painful than gaining $100 feels rewarding. The emotional impact is not balanced. The loss feels heavier, the pain feels stronger, the memory lasts longer, and traders experience this every day. Now let us discuss something fascinating. Researchers have found that emotional pain and physical pain share some similarities in how the brain responds. Think about experiences like rejection, failure, embarrassment, social exclusion. These experiences often feel painful, not physically painful in the traditional sense, but still painful. The emotional discomfort can be intense. A trading loss can trigger a similar reaction. The brain interprets the event as a threat. Not necessarily a threat to survival, but a threat to security, a threat to confidence, a threat to expectations, a threat to identity. And when the brain detects a threat, emotional alarm systems become activated. This is why losses often feel so powerful. Now, let us discuss expectations. Expectations play a huge role in trading psychology. Before entering a trade, many traders begin imagining positive outcomes. The trade will work. The market will move in their direction. Profit will be generated. Confidence will increase. These expectations create emotional attachment, even before the trade finishes. Then, something unexpected happens. The market moves against them. The trade fails. The loss occurs. And suddenly, reality collides with expectations. The emotional discomfort is not only about losing money, it is also about losing the future outcome the trader imagined. The trader experiences disappointment, and disappointment often feels painful. Now, let us discuss identity. This is one of the most overlooked concepts in trading psychology. Many traders connect their self-worth to their results. When they win, they feel smart. When they lose, they feel inadequate. When they profit, they feel confident. When they lose, they feel uncertain. This creates emotional instability, because confidence becomes dependent on outcomes, and outcomes are never fully controllable. Professional traders eventually learn to separate identity from results. A losing trade does not mean they are a bad trader. A winning trade does not automatically mean they are a great trader. The outcome is information, not identity. This distinction reduces emotional pain dramatically. Now let us discuss uncertainty. Human beings naturally prefer certainty. We like knowing what will happen. We like predictability. We like control. Trading offers very little certainty. Even the best setup can fail. Even the best analysis can be wrong. Even the most disciplined trader experiences losses. This uncertainty creates psychological discomfort, and many traders underestimate how deeply uncertainty affects them. The emotional pain often comes not only from the loss itself, but from the reminder that outcomes cannot be controlled. The brain dislikes this reality, and because it dislikes this reality, emotional reactions become stronger. Now let us discuss another important factor: ego. Many traders believe they are fighting the market, but often They are fighting their own ego. The ego wants to be right. The ego wants validation. The ego wants certainty. The ego wants proof of competence. A losing trade challenges all of these things. The market effectively says, "You were wrong this time." And that message can feel painful, especially when the trader's identity is attached to being right. Professional traders learn something powerful. Their goal is not to be right. Their goal is to execute effectively. This mindset reduces emotional pressure, because success becomes linked to behavior rather than prediction. Now let us discuss another reason losses feel so intense. The brain remembers negative experiences very effectively. Think about your own life. A single criticism may stay in your memory longer than several compliments. One embarrassing moment may be remembered for years. One painful experience can dominate attention. The brain does this because negative experiences are treated as important information. The brain wants to prevent future pain. Unfortunately, this mechanism can create problems for traders. A few losses may begin dominating their attention. Confidence decreases. Fear increases. Decision-making becomes emotional. The trader becomes focused on avoiding pain rather than following a process. Now let us discuss fear. Fear is often misunderstood. Many traders believe fear is weakness. It is not. Fear is information. Fear is a protective response. The problem occurs when fear becomes excessive. When losses feel extremely painful, fear increases. And when fear increases, behavior changes. The trader exits early, avoids valid setups, moves stop losses, refuses to take opportunities. The trader begins managing emotions rather than managing trades. This is where performance declines. Now let us discuss emotional attachment. Many traders become attached to individual trades. This creates vulnerability. The trader wants this specific trade to work. The trader needs this specific trade to succeed. The trader becomes emotionally invested, and emotional investment increases pain when losses occur. Professional traders think differently. They think in probabilities. They think in large sample sizes. They think in terms of hundreds of trades. This perspective reduces emotional attachment, and reduced emotional attachment reduces suffering. Now let us discuss another important truth. The pain of a loss often depends more on meaning than amount. A small loss can feel devastating if it threatens confidence. A large loss may feel manageable if it fits within expectations. This is why two traders can experience the same financial loss but react completely differently. One remains calm, one becomes emotional. The difference is interpretation, not the amount itself. Now let us discuss another hidden source of pain: regret. Many traders do not simply experience losses, they experience regret. I should have entered later. I should have waited. I should have followed my plan. I should have taken profits. I should have done something differently. These thoughts create additional emotional pain. The loss ends, but the mental replay continues, and that replay often hurts more than the original loss. Professional traders understand this. They review mistakes objectively. Then, they move forward. They do not repeatedly punish themselves, because self-punishment rarely improves performance. Now let us discuss another critical idea. Most trading losses are not actually dangerous. They feel dangerous, but they are often controlled risks: a planned loss, a predefined stop loss, a normal outcome. Yet the brain sometimes reacts as though something terrible happened. Why? Because emotional systems respond faster than logical systems. The emotional brain reacts first. The logical brain catches up later. This is why awareness is so important. The more you understand what is happening psychologically, the easier it becomes to manage. Now imagine two traders. Both experience the exact same loss. One trader interprets the loss as failure. Confidence collapses. Fear increases. Emotional decisions follow. The other trader interprets the loss as part of the business. Nothing unusual happened. The process continues. Confidence remains stable. The difference is not the loss. The difference is the meaning assigned to the loss. If this lesson is helping you understand your own reactions more clearly, consider subscribing to Bull Mindset, because mastering trading psychology begins with understanding how your mind works under pressure. Now let us continue with some real trading examples. Imagine a trader who enters a trade after waiting patiently for several hours. The setup looks perfect. The analysis is clear. The risk management plan is in place. The trader feels confident. The market begins moving in the expected direction. Everything appears promising. Then suddenly, the market reverses. The stop loss is hit. The trade closes. Financially, the loss is small. The account remains healthy. The risk management plan worked exactly as intended. But emotionally, something very different happens. The trader feels disappointment. The trader feels frustration. The trader begins questioning the analysis. The trader begins questioning the strategy. The trader begins questioning personal ability. Nothing significant happened financially, yet psychologically, the reaction is intense. Why? Because the brain is reacting to perceived loss, not just financial loss. The trader lost certainty. The trader lost expectations. The trader lost the imagined future outcome. And that emotional reaction creates pain. Now imagine another trader facing the exact same situation. The loss occurs. The stop loss is hit. The trade closes. The trader feels disappointment, but the interpretation is different. The trader says, "This was one trade. This was a planned risk. This outcome was always possible." The emotional reaction becomes smaller. The recovery becomes faster. The discipline remains intact. The difference is not the trade. The difference is the psychological response. Now let us examine another example. Imagine a trader who experiences 3 losing trades in a row. The losses are controlled. The risk management plan is working. Nothing unusual has happened. Yet emotionally, pressure begins increasing. The trader starts thinking, what if the next trade loses too? What if my strategy stopped working? What if I cannot recover? Fear begins growing. Soon the trader starts changing behavior. The trader exits early. The trader hesitates. The trader avoids valid opportunities. The trader is no longer following the system. The trader is reacting to emotional pain. This is how losses create secondary damage. The original losses are not the biggest problem. The emotional response becomes the bigger problem. Now let us discuss some powerful mental frameworks. The first framework is called separate outcome from identity. This framework changes everything. Many traders unconsciously connect results to self-worth. Winning means success. Losing means failure. This creates emotional instability. Professional traders think differently. A winning trade is feedback. A losing trade is feedback. Neither outcome defines personal value. Neither outcome defines intelligence. Neither outcome defines future success. The trade is simply information. When traders adopt this perspective, emotional pain decreases dramatically. The second framework is called planned losses are business expenses. Think about any successful business. Every business has expenses: rent, utilities, equipment, marketing, operating costs. Trading also has expenses. One of those expenses is losing trades. No strategy wins every time. No trader wins every time. Losses are part of the business model. The moment traders begin viewing losses as business expenses rather than personal failures, emotional reactions become healthier. Now let us discuss another framework, the probability framework. Professional traders understand probabilities. Every trade contains uncertainty. Even excellent setups lose sometimes. This reality is normal. The goal is not eliminating losses. The goal is managing probabilities effectively. When traders truly understand this concept, they stop expecting perfection. And when perfection is no longer expected, emotional pain decreases. Now, let us move into practical exercises. The first exercise is called emotional labeling. After every loss, pause for a moment. Ask yourself, what am I feeling right now? Frustration? Anger? Fear? Disappointment? Simply naming emotions can reduce their intensity, because awareness creates control. Many traders never identify emotions, they simply react to them. This exercise creates separation. The second exercise is called the 3-statement reset. After every losing trade, repeat these statements. This loss was planned. This outcome was possible. My job is execution, not prediction. These statements help retrain thinking. Over time, they reduce emotional overreaction. The third exercise is called evidence-based reflection. After a loss, ask yourself, did I follow my rules? Did I manage risk correctly? Did I execute according to my plan? If the answer is yes, the trade was successful from a process perspective, even if the outcome was negative. This mindset strengthens discipline. Now let us discuss another exercise, the 5-minute pause. After a meaningful loss, Step away from the screen. Do not immediately search for another trade. Do not immediately seek recovery. Pause. Walk. Breathe. Allow emotions to settle. Many poor decisions occur immediately after losses. The pause interrupts emotional momentum. An interruption creates clarity. Now let us discuss self-compassion. This topic is rarely discussed in trading. Many traders become extremely harsh after losses. They criticize themselves. They replay mistakes endlessly. They create guilt. They create shame. The problem is that shame rarely improves performance. Professional traders take responsibility, but they also allow themselves to learn and move forward. Growth requires accountability, not self-destruction. Now let us discuss long-term thinking. The brain often exaggerates the importance of short-term outcomes. A single losing trade feels enormous. A single losing day feels overwhelming. But professional traders zoom out. One trade means very little. One day means very little. 1 week means very little. Long-term consistency matters. This perspective reduces emotional intensity, and reduced emotional intensity improves decision-making. Now let us discuss acceptance. Acceptance is one of the most powerful psychological skills a trader can develop. Acceptance does not mean enjoying losses. Acceptance does not mean giving up. Acceptance simply means recognizing reality. The loss happened. The outcome is finished. The next step is moving forward intelligently. Many traders resist reality. They argue with it mentally. They wish the trade had worked. They replay events repeatedly. This resistance creates suffering. Acceptance creates freedom. Now let us discuss confidence. Many traders try to build confidence through winning. The problem is that winning cannot be controlled. Professional traders build confidence differently. They build confidence through preparation, discipline, execution, consistency. These factors remain under personal control. And because they remain under personal control, confidence becomes more stable. Now, let us discuss another important lesson. Pain is not always the enemy. Pain often contains information. A loss may reveal poor risk management. A loss may reveal impatience. A loss may reveal emotional attachment. A loss may reveal unrealistic expectations. Professional traders learn from pain. They do not become controlled by pain. This distinction is critical. Now let us move toward the final takeaway. Your brain is not broken. Your emotional reactions are not unusual. Human beings are naturally wired to dislike losses. The brain treats losses seriously, sometimes very seriously. That reaction helped humans survive for thousands of years. But in trading, those same instincts can create problems. The goal is not eliminating emotions. The goal is understanding emotions, managing emotions, responding intelligently to emotions. Remember this. A trading loss is not a personal failure. A trading loss is not proof that you are incapable. A trading loss is not evidence that success is impossible. A trading loss is simply part of the profession. The traders who succeed long-term are not the traders who avoid losses. They are the traders who learn how to experience losses without losing discipline. They learn how to experience pain without becoming controlled by pain. They learn how to experience disappointment without abandoning the process. That is real trading psychology. And that is where long-term success begins. The next time a loss occurs, pause. Recognize the emotional reaction. Understand what your brain is doing. Accept the outcome. Trust the process. And remember that one trade never defines your future. If you found value in this lesson, subscribe to Bull Mindset. Keep strengthening your discipline. Keep developing emotional control. Keep improving your mindset. And remember, successful trading is not about avoiding losses. It is about learning how to respond to losses in a healthy and professional way. Thank you for watching, and I will see you in the next Bull Mindset video.